Okay, let's jump right into this explainer. AMP, the hidden story. Today, we're uncovering the truth behind Ameriprise Financial's glossy headlines. If you've been watching the markets lately, you've probably seen this ticker flashing green, but there is a fascinating narrative beneath the surface that we really need to unpack today.
The stock just hit a brand new 52-week high of $553.82. I mean, the top-line numbers look absolutely incredible, right? We're talking 22% earnings growth and a staggering 55% return on equity. On paper, it looks like an unstoppable financial powerhouse. But, there's a hidden story the media really isn't telling you. A pretty complex web of red and green flags that could dramatically alter how you view this company.
So let's shatter a common misconception right off the bat. When people hear Ameriprise, they usually think asset manager, but actually a massive 65% of their operating profit comes directly from advice and wealth management. They're this wild hybrid of wealth management, banking, insurance, and asset management, just all rolled into one.
To figure out if this hybrid model is actually a good deal at its record high price, let's evaluate Ameriprise through the time-tested frameworks of three absolute legends: Ben Graham, Peter Lynch, and Warren Buffett. First up, Ben Graham, the father of value investing. We're going to apply his strict net current asset value framework. You probably know it as his famous cigar butt test.
So how does Ameriprise score? Zero. Literally $0. Now, this completely exposes the inherent high leverage of financial institutions. Graham himself warned us that banks and insurers need special treatment because of their balance sheets. So if you're a strict Graham disciple, this structural reality makes the stock completely uninvestable through his traditional framework.
Okay, let's pivot. Peter Lynch, the growth investor.
Here we're applying his classic PEG ratio rule, which balances price, earnings, and growth. By his standard, a PEG of 1 is fair value. Ameriprise sits right on that borderline. But when we try to calculate a specific fair value price, it reveals a pretty massive split in the data.
And this brilliantly illustrates the tension at the heart of this stock. Depending on which growth rate you use, you get two wildly different realities. If you use a 10.76% EBITDA growth rate, fair value is just $307, massively overvalued today. But if you believe their 22% net income growth rate is actually sustainable, boom, fair value skyrockets to $956. That's a 70% upside. It all hinges on whether you think that recent growth engine can keep running.
Moving on to Warren Buffett, the quality investor. We all know he's obsessed with the actual cash a business generates, owner earnings. And on this front, Ameriprise delivers a highly robust $59.40 in owner earnings per share.
So the crucial point is this: at current prices, that translates to a 10.8% owner earnings yield. Buffett would absolutely love that yield, right? Especially since it blows 4 to 5% 10-year treasuries right out of the water. But here's the catch. They only score a 6 out of 10 on the Guru Focus Moat Scale, meaning they just have a narrow moat. That lack of a wide competitive advantage, plus having earnings so tied up in market volatility and regulatory complexity, yeah, that would definitely give the Oracle of Omaha some serious pause.
All right, now that we've seen how the legends might view things, let's pick up the pace and uncover the 5 hidden green flags the mainstream media is completely missing right now.
First, don't be fooled by that seemingly low 1.23% dividend yield. The media shrugs at this, but the payout ratio is only about 16%. That means they are retaining nearly 85% of their earnings. They're aggressively using that cash to fuel share buybacks and long-term growth. It's basically a stealth compounding machine.
The second green flag is insider conviction. 52,900. That's exactly how many shares Director James Cracchiolo bought on the open market in July 2026. When insiders who know the business inside and out are putting that much of their own skin in the game, it's one of the strongest signals of confidence you can possibly ask for.
Add to that, they've got a $2.8 billion cash fortress at the parent level, backed by an AM Best rating, which gives them incredible flexibility. They're showing high fundamental quality too, an 85 to 87 out of 100 GF score and a GF value of $555, suggesting they are actually undervalued. Finally, their banking arm provides immense stability. Bank assets are up 6% to over $25 billion, and lending just grew a very impressive 61% year over year. But we have to shift our tone here. 5 glaring red flags. Because under the surface of these record highs and green flags, there are very real risks that absolutely demand your attention before you consider this stock. First and foremost is the structural risk, and it is staggering. We are looking at $178 billion in total liabilities stacked against just $6.2 billion in equity. That is nearly 29 times leverage. Now, leverage is great in a bull market, sure, but a bear market could severely amplify their losses. This glaring structural risk right here proves exactly why Ben Graham would walk away.
Beyond that heavy leverage, we're seeing persistent asset management outflows. If the broader market turns, their record assets under management could shrink incredibly fast. They're also dealing with high interest rate sensitivity, which threatens to squeeze their margins. Furthermore, Wall Street is clearly hesitating. You've got 14 analysts sitting firmly on hold with a $578 average price target, offering less than 5% upside. And finally, a moderately high 4.96% of the float is sold short. A meaningful group of investors is actively betting against them.
So, the final verdict. Let's bring all this evidence together, the legendary frameworks, the hidden strengths, and the undeniable risks, to see the complete picture of Ameriprise Financial.
This really synthesizes our entire investigation perfectly. The verdict is incredibly nuanced. It's not a Graham bargain because of those $178 billion in liabilities. It's not a Buffett-wide moat compounder because of its sheer complexity. But it is a highly profitable financial hybrid. It offers a super compelling 10.8% owner earnings yield and a modestly undervalued GF value around $555 with a high-quality score. It just happens to be weighed down by intense leverage and market uncertainty.
So, AMP. Opportunity or trap? With shares hovering right around $552, you've got this wild tug-of-war. High insider confidence backing the company on one side, yet heavily hesitating Wall Street analysts and short sellers on the other. We're going to leave the final verdict to you. Looking at this complex mix of red and green flags, which side of that uncertainty do you want to be on? Is this a hidden opportunity or a value trap waiting to spring? Think about it, and we'll see you in the next explainer.